Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is around family investment companies and the disadvantages that may occur for some people. So what are the disadvantages of a family investment company? So I'll start by saying there are plenty of positives for an FIC, and it's mainly the long-term control of assets while a person is alive without actually owning the assets for IHT purposes. Other major benefits is like the ability to set up alphabet shares, which means that income can be distributed to family members very tax efficiently. Also, there are no expected changes for family investment companies that are separate to any other limited company. Obviously, a family investment company is a limited company. But in the beginning of 2022, HMRC carried out a full review on FICs and they passed with a clean slate. So the disadvantages. Now, a limited company is generally considered to be an open vehicle. So therefore, if rules change, the change are effective immediately for the company. And therefore, if a rules changes are made to any type of limited company, it's going to affect family investment companies as well. So changes to tax rules, capital gains tax, corporation tax, tax on dividends, all affect companies and family investment companies immediately. Now, I get that tax rules can change for existing trusts, but really the mechanisms of how trusts work and their inheritance tax liability nearly always remains the same. Very unlikely to change for an existing trust. But that doesn't apply to family investment companies and limited companies because they are much more open vehicles. So there will be changes to FICs which affect it in the same way as other companies. Now, FICs do provide strong protection for divorce for family members when assets are passed down to them, but again, not as strong as trusts. So another disadvantage is that the cost of accounting may be higher because you have to do HMRC returns and company house returns every year like you do a normal limited company. Now, the costs of accounting will depend upon the assets that are in the company, but with trusts, quite often, especially if you hold offshore bonds in trust, then you only have to return once every 10 years. So we're nowhere near as onerous in terms of cost. But obviously, with family investment companies, you're not limited to an amount. You can put 30 million in, whereas with a trust, you're limited to 325,000, unless you want to pay a tax charge immediately, which no one does. So, however, in most cases, there are some disadvantages to family investment companies, but for people who've got a high value of assets, more than $1 million above the value of their main residence, then family investment companies are definitely worth looking at, and the advantages far outweigh the disadvantages. But in most cases, we recommend setting up both family investment companies and trusts to minimize the impact of future changes and use the different environments for their tax advantages as well. Okay, hopefully that helps. Thanks for listening and bye for now. Bye.